Welcome to the 5th video of the introductory video series of the Smart Money Tracker. In these videos you're going to learn smart money strategies of the wealthy in today's market. My name is Brian Netzel and I'll be your host. Here's our disclaimer. This presentation is educational in nature and is not a solicitation to offer, buy, or sell securities. It is intended for educational purposes only and is not a guarantee of earnings or profits, as individual effort and circumstances greatly influence the profitability of any financial endeavor. We are not financial advisors or tax advisors and do not practice law. For financial, tax, or legal advice, one should seek the counsel of a licensed professional. In the last video, we learned about the first challenge to any financial plan: time. We saw how important it is to save and invest in all stages of life so we have enough when we need it the most. In this video, we're going to discuss 3 more challenges to a good financial plan: inflation, stock market fluctuations, and your pension. Challenge 2. Inflation, the value of the dollar. As mentioned earlier, a plan for financial freedom must take into account the role of inflation. Whether we are a miser or a spender, the cost of everything eventually rises. While the U.S. inflation rate has thankfully never been as severe as some other places in the world, the buying power of the dollar has nevertheless eroded over the years. When I was a boy, one of my first entrepreneurial ventures was mowing lawns in the neighborhood for extra money. I remember marching off to the corner gas station with my little red 1-gallon gas can for a fill-up each Saturday in order to mow the grass of my weekly customers. At that time, during the 60s, a gallon of fuel was only 25 cents. In fact, I recall there were 2 gas stations on opposite corners that were constantly engaged in price wars to beat out their close rival in lowering their price, emblazoned in large red metal numbers on a large display board that was changed sometimes by the hour. With prices north of $4 per gallon today, more than 10 times more expensive than it was 40 years ago, one must conclude that when we are beyond our money-earning years, we must have enough saved and invested to account for the eroding effects of inflation. And if you think that gasoline is an isolated example, consider that in that time a dozen eggs cost 25 cents and now cost $3 or more. A loaf of bread costing 25 cents in the 60s now weighs in at $4 plus. Lesson: however we choose to invest, we need to make sure that it appreciates faster than the inflation rate, or we experience a net loss of buying power. Challenge 3. Stock market fluctuations. Many people today invest in the stock market through mutual funds and some through individual stocks. Many hope it's a way to build wealth so they can one day enjoy the good life. Some even hope their stock investments will enable them to quit their jobs early, take some time to relax, spend more time with their family, enjoy vacations, or engage in their hobbies. As you know, the stock market has made some people a lot of money, but the problem is that share prices can fluctuate greatly. If a stock goes down 50%, it has to go up 100% just to get back where it was. Here's an example. $100 worth of stock goes down 50%, is now worth $50. Now that $50 worth of stock has to go up 100% to go back to a value of $100. This has actually happened to many people if you look at the stock market's returns in the last 10 years. Because of downturns, $100 put into the stock market in the year 2000 is worth about the same today, about $100. Fluctuations have really hurt people's returns. Imagine how unfortunate it would be to sell your stock when stock prices are down. We never know where the stock market will be when we need to sell. Yet this is exactly the risk we face when we turn 70 and a half and have to start taking regular installments from our IRAs, 403b, or 457 accounts. And what do you think will happen when millions of people start cashing out their IRAs at the same time? If there are more people selling stocks than buying, the price of the stocks will drop. And that is what some key economists are predicting will happen when the baby boomers start to retire in greater numbers, those born between 46 and 64. The generation of workers who will be buying their stocks, Generation X they're called, born between 65 and 85, is not as large. The law of supply and demand predicts that when the supply exceeds the demand, the strike price of the commodity will fall. Can millions of baby boomers afford to lose even more of their retirement savings due to stock prices dropping? Lesson 1. Don't count on the stock market exclusively in your investment portfolio. Lesson 2. When you invest, purchase the asset at a price that accounts for the downside risk of losing value by purchasing at a discount if you can. Then if there is a market correction, your investment has a protective cushion against downturns. Challenge 4. Your pension. Many employees today have company-sponsored 401k plans that allow them to contribute a set amount each month to company-offered stocks. Some even allow them to purchase stocks and mutual funds of other companies. While the choice to invest in a 401k is better than nothing at all, most workers today are not aware of just how at risk their accounts are to market downturns, especially in certain sectors like technology. When millions of U.S. workers woke up one morning to discover that their accounts were worth half as much as the week before in 2007, they got a very fast education in the downside of what are called defined contribution plans. It was not always this way. In the not-so-distant past, workers were well protected with defined benefit plans. In these plans, the amount you would eventually receive when you retire was set or defined ahead of time. That all changed for the majority of U.S. workers in 1974 when Congress enacted the Employee Retirement Income and Security Act. In that bill, they instituted the 401k plan, which would give workers more control of their retirement dollars. The shift away from guaranteed pensions was encouraged by Congress, which structured the rules in a way that invites corporations to abandon the defined benefit plans in favor of defined contribution plans, increasingly the 401k, in which employees set aside a fixed sum of money toward retirement. But a focus on the shift of who controlled the investment actually masked the most powerful issue: how much it would pay out at retirement. Lessons sometimes come at a high cost, and the market downturn of 2007 taught the observant that they cannot count on their company retirement plan alone to take care of them. If people live longer than expected, get stuck with unanticipated expenses, or suffer losses from anticipated benefits, their shock may be compounded when they learn that even Social Security is not there to help them. Even city and state retirement systems are in trouble in many places. Though workers were promised set payouts, these municipalities are finding it nearly impossible to pay for them because these plans are dependent on the stock market as well. In fact, cities are finding it necessary to cut back on retiree benefits to pay for current expenses and salaries. Shortfalls in retirement funding due to the downturn in stock prices has caused many retirement funds to make up shortfalls from the general budget. The reason is that most pension systems, regardless of who administers them, are heavily invested in the stock market. When stocks go down, the pensions go down in value as well. Lesson: we must have other sources of income for retirement in addition to our company or government plan. Do you know about the Pension Benefit Guaranty Corporation? This federal agency exists to protect public pension funds and keep them solvent. Did you know that now this agency has been called upon to bail out a historically large number of pension systems? In fact, so many that now the agency itself is at risk of failure. Here's an article about them. The deficit at the federal agency that guarantees pensions for 44 million Americans tripled in the last 6 months to a record high, reaching $33.5 billion, largely as a result of surging bankruptcies among companies whose pensions it expects it will soon need to take over. How much longer this fund can cover deficits in pension systems nationwide is anyone's guess. but this simply places more doubt upon the public's ability to trust pension funds to take care of them in their later years. Lesson: we cannot trust any branch of government or their agencies to bail out our retirement plans because they simply cannot afford to do so. Add to this the fact that many company-sponsored retirement plans have been raided, from United Airlines, American Airlines, and a growing list of others. When companies experience financial difficulty or merge, the retirement funds supposedly kept safe for workers are often raided and recast to decrease actual payouts for people who have devoted their entire careers. Lesson: we live in a new day when we are largely on our own. We must seriously assess whether our retirement income will grow and be safe enough in company, public employee, and municipal plans because they all largely depend on the stock market. In this video, you have seen that inflation, stock market fluctuations, and your pension must be accounted for in your financial plan. In the next video, we will look at the challenges that the future of Social Security and our health present in our quest for financial independence. In this video series, you will continue to get valuable information that helps you take charge of your financial future. The purpose of the Smart Money Tracker is to provide timely market and investment information that equips our members to match the best strategies of wealth generation that exist today. If you would like to track and match the best wealth building strategies that exist today, visit our website. Or if you are not yet a registered member, we invite you to join to receive full access to our resources, including the full version of our Smart Money Strategy e-course, member forum, resources, vendor directory, case studies, and more. thesmartmoneytracker.com. This is Brian Netzel. Until next time.